All right. Okay.
Okay. Can you please tell us what we're looking at?
Okay. So let me do this really quick. So Dave, why don't we do this? Hey, would it be important for you right now if throughout your retirement we could preserve your principal, preserve your income, and increase your income 3 or 4 times? Once again, while going out through retirement, being able to maintain your principal. Would that be of any interest to you?
Sure.
Okay, awesome. So would it be okay if you and I walked through a mathematical formula that would show you how to achieve that?
I would love to see it.
Awesome. So let's do this. I'm sorry, Dave, how old did you say you are again?
Oh, I'm 60.
Okay. And I think what we talked about before is you would want income to start at 64.
Yeah, we're thinking of retiring at maybe age 64, 65.
Okay. So let's use 64 as an example really quick. And you and I discussed $500,000. So
Correct.
what I'm gonna do, Dave, is I'm gonna put $500,000 in, and I am going to show income starting at age 64. And if it's okay with you, we are going to use start your income based on 5.5% withdrawals. So for an example, 500,000, we'll start taking 27.5. And then what we'll do is I'll increase your income, and you can see that here.
Yeah.
I'll increase your income up to 30,000 at the age of 70, and then we'll increase your income to 32.5 at 75, and then we'll increase your income again at 30 to 35,000 at 80. And all the while, what we're attempting to do is preserve principal, preserve income, grow your income while we go. So does that make sense?
How did you do that, Rick?
Well, it's not me, man. It's called math. And
Okay.
so I'm going to share some formulas with you that we've been working on over the years. And kind of here's why. We have a lot of clients who come to us. You know, in the old days, you and I could go get 7% guaranteed, live off 5% interest, you know, let it grow, and then take a little more later. Sadly enough, in the past couple decades, we just can't do that anymore. So we've had to find ways to, be more creative. And so here's a couple things that, we like to teach our clients when we do this. Once again, we want to preserve principal, preserve income, increase income. I'm going to try and do no fees if that's acceptable to you, no or low fees. I'm also going to set this up in such a way for you that it's really easy to manage. It only takes literally minutes a month for you to manage. And then it's based on having complete certainty. I never want to worry about this thing again once we set it up. However, to achieve that, there's some pitfalls. You and I can talk about these later, but things like the sequence of returns, what happens if you were to take losses, using the wrong withdrawal rate. This formula eliminates all these pitfalls. And to do it, though, there's some very specific things that have to happen. So let me share that with you really quick, and then we'll show you the numbers. And then I'll show you how we do a live search so you can actually see it for your own eyes live while we search.
Wow.
So one of the things we look at is this thing has to be mathematical. I don't want you to guess, and I don't want to guess. I want to know exactly what it takes to make your goal happen mathematically. And second of all, there's just not one product that makes it work. We found that we've got, a couple different strategies we have to use in some different products. I also believe that based on the money that you're putting in, we should peel some off for the reserve, or for what I call a reserve fund or reserve bucket. So we just have extra money sitting out there in case you need it. And we're going to be using contractual or insurance-backed products. So this could combine fixed index annuities, multi-year guaranteed annuities, maybe even some SPIAs, and I'll share that with you in a little bit. Once again, no or low fees. I need your principal to be guaranteed to make this work. And here's the catch. If you've ever invested in the market before, in fact, have you had money in the market before?
Yeah.
Okay. Was it kind of a nuisance for you? Like, especially with COVID, hey, my 500 was worth 550, the market crashed, and then I was worth 400.
That's why I kind of reach out to you, because I believe the stock market was going up for so many years and it's ready for the correction. So I just wanted to find something so I could preserve my money. And if it's growth, then obviously I can get maybe some growth. And then when I'm ready to retire, maybe we can talk about the income for life.
Excellent. And you just nailed it is, gosh, the market's high and I don't want to give up, what we have earned, right? And we like to call that portfolio renting, meaning it's really not mine until I take it, right? So if it goes higher, I'm renting unless I take the money. And so what we do is make sure that our system, once you have earnings, you lock them in and they can't be lost to market risk. So if we follow these requirements here, I'm going to be able to show you once again, preserve principal, preserve income, and grow your income, and bluntly never have to worry about it. So that being said, let me get you some real numbers. I'm going to make your screen a little bigger for you because I know sometimes these numbers can get, frankly, sometimes they create a headache for me. So I'm going to share you how we did this. And so I'm going to start with my basic. This is just my very basic initial plan. And this is a program that I ran a while back, and it's become very popular. It combines 3 different fixed index annuities. And here's how it works. The first thing I want to do on your 500,000 is you'll see that these numbers can change for us. And I'm just showing you this so you can see how these populate. I want to take 5% of your 500,000 and I want to put it into the reserve fund. This is just going to grow by itself in case we need it for something down the road. Okay. That leaves us 475,000 to go and invest. And what I'm going to do is I'm going to put this into an investment that has a 3% upfront bonus, which is why you see this. And so this immediately is worth 489. And then I'm going to use right now a 5% growth rate on that money. Okay. And the reason that I want to use 5% is I think it's super important that we be very conservative with your game plan. And I'm then going to show you vehicles that do not have market risk, guarantee principal, that have had returns higher than this. And I'll do that when I go to our search. All right. Also, your reserve fund, I'm just going to grow that at 275. That's what this is growing at each year. This is going to be, there'll be a lot more opportunities for us, but I'm just, again, using a very basic, very conservative initial approach. So let me show you how this thing works. So we have our 25 goes into our reserve fund, the 475 gets invested. We get a little bonus on here up front, and we're growing at 5%. We're going to let this money grow for the next few years until we take our first income at age 64, as per your and I discussion. And what I'm going to do is for the first 4 or 5 years of your retirement, we'll keep that 27.5 while we try to grow your portfolio. Okay. Now, here's where this gets really fun, Dave. Would it be cool if you and I, about maybe 5 years down the road, 6 years down the road, said, hey, Dave, would you like a raise? And we bumped it up to 30,000. And then maybe 5 more years down the road, we said, hey, would you like another raise? How about 32.5? Another 5 years down the road.
How do you do that?
Okay. And here's the thing. We go back to our little formula. If we guarantee principal, don't pay fees, and lock in your returns annually, and all we have to do is earn 5% or more, look what happens to the far right portfolio value over the next 40 years. As per our initial discussion, we are trying to maintain your principal, trying to preserve and grow your income. We gave them 500, we got back 1.2 of income, and we still had our 500 sitting there. Would those numbers work for you?
That's pretty good.
Cool. Would you like to see now how we go find the product to make these numbers happen?
That's interesting.
All right, let me share this with you really quick because, Dave, the first time I did this, it blew my mind. I don't claim to be a programmer, so it took a guy like me a long time to make this, but I couldn't really find any planning software out there, so I was kind of forced to make it myself. And after I built it, what I found now is I could actually go search live for the products to make these numbers happen. So here's the cool thing. You and I were just talking about what happens if all we do is earn 5% on the growth money and 2.75% on the reserve fund money. So this is where this really gets cool. Has anybody ever done a live search for you on how to successfully buy an annuity?
No.
Okay, I'm going to show you some of those powerful stuff that we have available. I used to have to do this all by hand and manually, and it took me forever. Now I get to show you this live right now. This is a piece of software, online software called Annuities Genius. It allows me to search in real time the best performing, top performing annuities in the country immediately, which is cool for you, the consumer, because now you don't have to have somebody telling you, this is the best one, this is the top one, or any of that stuff. We get to go right to the source now and find the best one. So
Yeah,
this
so
is,
nobody can tell me, now they can show me the truth.
you're going to get to see this live right now, which is absolutely awesome. So here's what I like to do when I do a search like this. So we are going to be searching for fixed index annuities, as we discussed.
Uh-huh.
What I first like to do is I want the most recent performance, which is going to bring us the last 10 years through May 1. And what we're going to do is let's put in your premium of 500,000. And I always do my search in Arizona. I'll explain that later. But the reason I use Arizona is because it allows me to search all product that I want you to see. So you can see them all. And I want to use companies B++ and higher. You and I can actually talk about ratings as we go further. But for this initial search right now, I just want to show you how we might populate the game plan that we just looked at. So how do we make this real, right?
Yeah.
So this is really cool. So watch this. I want no caps because I want you to have the highest earning potential. I want no account fees. And I want no rider fees. I just want to figure out, hey, how much money can I go make? And will it satisfy the plan that we just looked at? So this is cool. If we look through May 1, and again, we're looking at companies B++ or higher, and we want no caps, no riders, no fees, no market risk with returns locked in. We based your plan on 5%. Look at these returns.
That's in the last 10 years.
Yep, without market risk.
Without the market risk, what this particular fixed index annuity would have, should have done if all those participation rates and stuff will be the same, right?
Yeah, and so here's what happens is had you and I invested 10 years ago, and by the way, the 3% bonus came from an annuity like this one right here. And so yes, to your point, had you received 150% participation rate with a 3% bonus on this Fidelity index, and you earn credits every 2 years, your 10-year return would have been 937. Okay. Now, we wouldn't just put all your money here. I'll show you in a few minutes here how we allocate. But the reason that I'm showing you this is here's the number of 937. And what's really cool is, what's really cool when I look at this, bear with me 1 second, because I wanted to go through my allocation. Hold it. Let me move this out of my way. I got something blocking the top of my screen here. Okay. Here's what I can do. I can go like that and then go back to my tab. Okay, sorry. All right, now let's try this. So let me go to the back test on this annuity. And so what's really neat about this is that we do all of our planning. These are the different allocations available in a fixed index annuity like we looked at. And what we immediately look for is those that have different accounts in them with a worst case that has to be 5% or more, because our plan was built on 5%. And what we find awesome is you can build a diversified portfolio, within a fixed index annuity as far as your credits. And we have worst case scenarios all north of 6. So let me show you what happens here. This blew me away when I first saw this. If I take this thing and all I do is increase it by 1%, if that were to happen, look at your values over the next 40 years plus the income you took. Is that amazing or what? A 1% difference.
Yeah.
Now, I'm sorry, let me get some of this stuff off my computer here. Okay, so now you can imagine if we were to be able to achieve that, how much more could we increase your income? So what we love about this formula is that we now have product available if we set this up properly mathematically. Don't take risk, lock in returns, don't pay fees. You can put your money in, never worry about it again for the rest of your retirement, and still have increases.
Very interesting.
Now, I've given you a ton of information. I apologize for that, but I kind of wanted you to see the 30,000 foot view of this thing. Questions that you have for me?
So this is how the growth was with this particular annuity in the last 10 years, I guess.
Yep, and you and I obviously can't, I can't near predict. I can't near, predict what the future is going to hold. But the neat thing is that I think you and I both agree the market over the next 10 years is going to do what it's always done. And if what we do is guarantee our principal, not pay a fee, and lock in those returns as earned, and can't lose them once earned, then we're going to get competitive returns. The last 10 years of the market was, there's been some up and down, obviously recently COVID and all that type of thing. And I expect the next 10 years to be the same, volatile up and down and so on,
Right.
And so that's why we use a 5% planning formula. And that's why we look at programs' worst case scenarios that are more than 5%.
Very interesting.
And so here's what we love to do now. So we look at this, and as I'm planning for you, as we discuss your goals, I ask myself, okay, so what we are attempting to do originally is take this $500,000, guarantee the principal, preserve it throughout retirement, take income, preserve that throughout retirement, and then grow it throughout retirement. So that's kind of what we talked about. Did I miss anything?
No, I think that's exactly what I wanted to do, is preserve my capital and then maybe generate lifetime income after I retire.
Awesome. And so based on the numbers that we've looked at so far, if we could find the vehicles that didn't have the risk, didn't have the fee, locked in your returns, and paid more than the basic numbers that meet what you're trying to achieve, would you want me to put together a plan for you?
Yeah, I would love to see the plan, especially as that platform you showed me have all those annuities and all the insurance carrier from the whole country.
Yep. So let me get back to that. So that's a great question. So let me X out of here for a second. So this is cool. So let me spend a minute with you on this, because again, I started teaching a program. You're going to laugh at me, but it's such an original thing. Back in the 90s, it was called Rick's Annuities Purchase System.
Wow.
How original. But the purpose of it, though, was to teach seniors how to successfully invest into annuities. And so I used to search all the companies by hand and do all this stuff, and then run illustrations and try and get all the returns. And so about, I don't know, a couple years back, year and a half back, I began to do a massive focus on, is there any firms out there that are creating software or online search or anything like that that would allow me one place to go where I could search all the companies and get real live returns, on the spot. So I didn't have to go and, go find them, come back and run the illustrations and that type of thing. And so when I began this, as I mentioned earlier, this particular program is called Annuities Genius. And what it allows me to do is search all these plans. So let me share something with you. Has anyone else been offering you any other annuities to look at?
Yeah, I spoke to my bank.
Okay. Do you have the name of somebody's annuity? Let me kind of show you how powerful this thing is, because this is pretty awesome.
I believe they show me some annuity from some company. I don't really remember the name.
Okay. Well, let me give you a few quick ideas on this then. That being said, so there's about 40 of these policies right here, 40 of these per page. So
Wow.
to your question, does it show all of them? Yeah, watch this. Right now, this particular search is going to show us the top performing or the past 10 years through May 1. Okay. Now you'll notice I'm getting through here, and some of these company names, maybe you know, maybe you don't, but let me give you an idea of how many are in here. So see these are the pages. So there's about 40 per page. So we're at about 440. Okay. I'm going to skip down here and I'll give you an idea of why this is so powerful now. Some of these companies you might know. Have you ever heard of MetLife?
Yeah.
Okay. Well, there you go. That's MetLife. That's Bright House. That's the annuity division they sold off. So that was MetLife. Have you ever heard of Prudential?
Yeah.
Okay. Maybe North American, maybe Protective, but Nationwide, Allianz, Athene.
Wow. This,
Okay.
this,
So
this platform have pretty much all of them.
yeah. And so what'll happen is anybody that somebody's shown you, it's in here. It's just a matter of how low on the totem pole it is. Okay. So these guys, there's lots of these companies that offer these annuities. And in the past, you were, pretty much at the, disposal of your agent, having to kind of trust them and go, hey, I'm sorry for all these. I should shut that off there. In fact, hold on one second. Let's see if I can prevent that. I'm getting a lot of emails today. Okay, so what'll happen here is that, we used to have to kind of trust them, but here's the thing. If, these 10-year returns, and again, we can't use past performance to, say what the future is going to be. However, this is vital to know because these are big time companies. It just so happens that the indexes they were using only had, 3.2% as an example, compared to, watch this. Oops, there we go. Sorry, it's such a long thing, but I used to have to do all that by hand, so it's kind of neat to do this.
Wow.
Instead of like 8.6 or 9.4, not, you know what I mean? So this is really powerful stuff. So now you, the consumer, gets to see this stuff live. You never have to have an advisor anymore tell you, hey, this is the one my mom has, or this is the best rated, or the top 10, or any of that stuff. We get to see this live. So when we make our planning decision, once again, I'll go back to our thing. Once we make our planning decision on this stuff, now we get to go get the facts. And we get to build our plan based on, performance and not opinion. Does that make sense?
That is very, very cool. So how we can maybe put some money into this?
So here's what I like to do when I'm building an income plan like this. And once again, I know I've stated this a couple times, but I just want to make sure if I'm crystal clear on exactly what you're trying to achieve, then the plan that I'll create for you and with the tools that I have in front of me, my goal is to just build you the greatest plan that's available. Okay. And so I just want to repeat this one more time, and then I will prepare a couple of these, and I'm going to schedule another one of these calls with you, and I'm going to go exactly through step by step the plans. And so let me just reiterate this one more time. What you've told me so far, Dave, is Rick, if you could guarantee my principal, preserve my principal throughout retirement, guarantee me income, increase my income, and once again, do all that without market risk. That's what you're looking for. And we talked about maybe starting income like in 4 years or so. Have I missed anything?
I think that's exactly what you want.
Awesome. And do you, by the way, do you like the idea of having a reserve fund over here growing by itself, not relying on income? Does that, or do you have other money that you would do that with and I can put this back in?
We can probably use my wife's another IRA. She have another 650,000, I think.
Okay, so because if I do this for you when I build this plan, the minute I knock out that reserve fund, oh my, um, your money even grows more and we can even take more income. So let's do this. I'm going to build you something here really quick and we can do this, the next day or two. But here's the thing. I'm going to take out this bonus for a second too. If we're going to make up the reserve fund with other funds and this 500,000 is standalone, what is the 27.5 figure, which is a 5.5% income? Is that kind of a figure you were thinking of? Do you want less than that? Do you want more than that?
That's pretty much exactly what I was looking to get.
Okay. Is it okay if we then increase it up to a 6% withdrawal, then 6.5, and then 7? Does all that look good?
That really look good. And how that works? I just have to keep my money longer?
No, all that happens is I'm just asking you when you would like a raise.
Yeah, that looks really, really, really cool.
Okay, so here's a couple things that I'm going to focus on if this is okay to you. I am not going to worry about a reserve fund because you've just said that you would have funds elsewhere to make, use for that reason. And then what I'm going to do is I'm going to go do my search again, and I am going to then look for the highest performers that I can find. And on your 500,000, I'm going to look at 2 different programs. And what I'm going to do, and let me just give you an example. I like to have your money come liquid in the next, 8, 9, 10 years, because do you remember back in the 80s when we could get 17% on your money?
Yeah.
Okay. So what happens if 10 years from now we have all your money still sitting there and all of a sudden there's 8% guaranteed for 10 years or 10% guaranteed or something that's available? I'm not saying you would do anything, but here's my thought. What if down the road we give you all the flexibility to either keep doing what you've been doing and we're happy as can be, or you're positioned that if something is better, you can take advantage of it? Would that be cool?
That's really cool.
Okay. So here's what I'm going to do then. I'm going to build you up a plan. I'm going to do some more searching here that I will do with you again when we meet next. And I'll have a couple of these that meet some very specific criteria that we're looking for. And let me share that with you super quick, what I'm going to be looking for. Some of these programs maybe only have 1 or 2 choices for us to invest the money. And what I'm going to be looking for, we discussed this a little bit earlier, is that I want each policy we look at to have very specific policy requirements. I want it to offer you a competitive fixed account. I want it to offer you a competitive equity account, a competitive balanced account, and then I want 1 and 2 year crediting strategies. And we also like volatility control. And the reason is because volatility control par rates are way higher than the ones that don't have volatility control. And if I can achieve all those things for you, Dave, we've positioned you without market risk to have the highest potential earning. I'm not saying we're going to get it, but you're positioned for it. Does that make sense?
Yep, definitely does.
So I'm going to be looking for 2 programs that offer all those requirements. And when we get together next, I'm going to walk through our just numbers once again briefly here, like we taught, just to make sure we're on the same page. I'm going to do our search, and I'm going to show you a couple of plans that meet those requirements to make that happen. And if that's acceptable to you, I will use my tools here to build you that plan that you won't have to worry about. That'll be easy to manage. Sound cool?
Yes, thank you so much. That's exactly what my family is looking for.
Awesome. So what I'll do is, why don't we schedule our next call right now, if that's cool with you?
Sure.
That'll give me time to prep, and then we can go from there. Oh, Dave, boy, if we had a link to Calendly or our calendar on here, I would click it right now and book you.
Uh-huh. Okay.
Cool. So let's do that, and we are good to go. So let's see. Today we are sitting here on, let's see, Tuesday. Can we do this again on Thursday at the same time, Dave?
Great.
All right. I will put you down for 1 o'clock Mountain Time on Thursday here, and then I'll have all your information prepared, and then you can tell me then if that meets your needs.
That is really cool.
So that's it, brother. That's the income one.
That's the growth one, I guess.
Yep. So this is the income and growth one. So this would be where I'm not doing any riders or anything like that. I'm just building what I call, and by the way, I've probably done some teaching previous to this with real money versus rider money. So like, for example, they may have gotten a lead magnet or been offered a lead magnet about retirement planning. And then they may have gotten something, one of the big traps to income planning is rider money versus real money, right? And then so there'd be a little heads up on that. And so this is a pure real money approach. And by the way, if this did happen, what happens if in here I've got 8 or 9% guarantees, 7% guarantees? I never have to leave, but I get another sale. So we either stay or we move because it's better. So they're in an incredible position.
Mm-hmm.
So that's, I really try and avoid the rider stuff. Now, usually I do a rider if they don't have enough money.
Uh-huh.
Then the rider becomes really cool for me. Then I'll be like, okay, so why don't we do it this way? What if, because then you were going to run out of money anyway. Maybe your 250 is not enough to give you your life, but what if I can guarantee it? Then I would, hop into the Genius, and I would, then start to look more at the, rider stuff. So we would say with income rider, I'd get rid of some of this stuff, and then we'd start to, do our searches, based on the solver or what have you. But that's my basic income, my preservation of principal income plan. And also what I'll mention in here too is if I start like at a 5% even income, they've got 20 years of income guaranteed, because I'm just taking 5%, so I think this is kind of cool. And especially when you start playing around with these. Hey, what happens if we got 3 here, only a 0.25% difference? What if all I got here was 5.5? Look at this thing, it blows up. I doubled my money 40 years from now, man. Plus the income.
Yeah.
So this one's kind of cool. And there's a few flubbies in here, like this income date should spur on the initial income withdrawal, right? And it doesn't, so I have to manually do it. These work. I forgot to include the reserve fund interest earned in the first year, so there's a couple flub ups that I have. But when I put the age in here, it populates. When I put the premium in here, it populates. This was going to be touch this, and it goes to my sequence of returns chart. Touch this, and it shows it, what happens to the S&P with losses.
Uh-huh.
This was going to go to I show a 4, 5, 6, and 7% withdrawal rate. This was going to show my fee calculator. This was going to show hey, if you use a market product, what happens? So, and that follows up here. This was when I clicked it. Going to, talk about being vulnerable. So all these were going to be live. Just haven't got to it yet. And then these numbers were
You didn't make them yet.
Correct. And I'm having a hard time trying to figure out how to link this box to my presentation. But again, I'm trying to do so many things. I was like, screw it, I'll get to that next week. But this is what I envision kind of being, part of the tools in the planning tool portion of it. So Josh and I were talking yesterday. I was like, oh gosh, this would be great. So we could have annuities genius, planning genius, income genius, marketing genius, all the geniuses. And then I showed
what we're trying to accomplish.
Let me see if I have it handy here. This is last year's, if I can find it. So here's a playbook that I built. And the thing that, sometimes I didn't update I haven't had a chance yet because I've been focusing on all the building of the other stuff. But this is a combination of Excel stuff and PowerPoint stuff, and then dropped into, PDF format. And so I talk a little bit about when up front with folks about why retirement portfolios fail.
Yeah.
This is just studying seniors for 20 years in Arizona going, why did their thing get screwed up, and just putting it all on something like this. So we talk about the retire line, their journey through crap they got to be aware of. And what I do is I talk about the concept of the thing that's happening today in the world is AUM. It's go collect as many assets as you can for a fee, let the client take the risk and hope that you get a good return, hope you don't lose. We do something different. We do asset preparedness, preparing your portfolio for this journey. So big difference, just a different approach. We look at all those things that have negative impact on the quality, and AUM has a lot of faults, fees, losses, risk, so forth. We talk about a retirement certainty map, all the different stuff that they should be looking at, over the course of their retirement. We teach them that junk. Our planning process now just got a lot shorter with the Genius, so I'm going to revisit this one. Our core of anybody's retirement is income and portfolio without risk fees, those things that screw up stuff. As a freebie, hey, I'm not an attorney, but here in Colorado, how's your house owned? Oh, it's joint. Okay, well, it's when you die, if the two of you die, is it possible you die together, in a crash? If so, that thing's going to probate. So do a beneficiary deed, make sure your stuff's all owned properly, you have your docs in place, blah, blah. And then let me skip down to some other cool stuff. I talk a little bit about what happens, typical asset allocation. In my opinion, nobody should have a bond mutual fund ever again with a good fixed index annuity. How long it takes to recover losses, the return, that stuff required. Hey, by the way, 92% of the portfolio managers aren't going to beat the S&P. And then, of course, it's even worse because then the investor buys and sells at the wrong time. So the S&P historic average is 7, but we get down to 5 because we're whatever. Because we buy and sell at the wrong time. And fees are one of the killers. Like, I love this example, 6% with a 1% annual fee, 6% versus no fee. My taking what the cost of those fees are over time, $238,000 in fees creates a $450,000 difference in portfolio values. And then here's the sequence of returns. So like this page right here, the updated page, because I have 2019 in my new one. When I click that one button, it should go to this page where I teach sequence of return. So Dave, is your portfolio right now set up to withstand early losses? Like if the market drops in the next few years, would your portfolio drop as well, or are you set up to withstand those losses? Let me teach you the sequence of returns. So here's what somebody investing in 2000, they suffered losses early. They took $5 grand, 25 grand a year. Now they've only got 163 left, even after it's actually 190 after 2019, but even after the big run. Now, if you take the same returns and inverse them, so your losses happen later in retirement, your 500 is 634. So the key then becomes is if your portfolio is not set up to withstand early losses, my suggestion is you redesign it.
Right.
And then the other thing that we'll talk about really quick is what happens if I take the S&P from 2000 through 2018. I'm just in the market. I go up and down with the market. What happens if I don't take losses and get 54% of the price of the S&P? I've got, oh, look, I've got more money. And so, Dave, one of the things when we build your program is I'm going to build it on the premise of, can I guarantee your principal, lock in your returns as earned, not pay fees, and compete with the market? Would that be cool to see?
Yep.
So we like to do that. And then, by the way, why go through all this, Rick? Well, on your $500,000, if after all that is said and done, let's say all you did get was 5%, over 10 years, it's 814. If we got you to 7%, it's 983. If you had an extra 170 grand, would that be of any interest to you? And all by reducing fees or limiting fees, reducing or limiting risk.
Yep.
That's what we're shooting for, man. And one other thing, since you're going to take withdrawals, here's something that's huge. Here's a 4% withdrawal rate between 2000 and 2018 in the market, the S&P 500. We've got 376 left. If we did that with principal guarantee and only getting a portion of the returns of the market, we've got 590. So that loss thing is huge, and your withdrawal rate number is huge. Here's the same thing at a 5% withdrawal. I still almost got all my money. Here, oops, I'm starting to get really worried that I'm going to run out of money. If you take too much, if you took 6%, you actually ran out of money in 2017. If you took 7%, you hope you died in 2012. So this is all the stuff that I'll be focusing on when I build your plan. And again, we're going to be looking at guaranteed stuff and see if we can, again, preserve principal, preserve income, grow your income, and still have all your money down the road. Cool?
Cool.
So Dave, these are, and I don't break all this out for everybody, you know what I mean? But it's here. I've got my arrows in my quiver. You say this, I go to this.
I got it. So this is your one presentation, or today we did one presentation of two, or?
You just got two. You got my playbook presentation.
Oh, we just got two, right?
Yep. And then this was the actual, planning presentation. But I opened this up for you because I sent this to Josh, going, wow, if we could put some of this in the planning genius while I'm in here, while I'm in the genius, and I come down, scroll down, and click my library or whatever you want to call it.
Yeah.
But somebody says, well, yeah, my guy's talking about a 6% withdrawal rate. Really? Do you know? And it's in the market? Okay, cool. Have you done any studies on the different withdrawal rates at all? And are you familiar with the sequence of returns? Well, no, I'm not. They didn't say anything about that. Cool. Can I show you the impact of that on your portfolio? Just take a second. Oh, okay. All right, cool. So, then I would go to that thing. I'm getting blocked here. Hold on, let me see if I can get in there. There we go. And then I would, flip to that page or whatever and then show them, And so then I have all of my stuff. I mean, you can't say no to me, dude.
Uh-huh.
If I do it right, these parts are more, it's my playbook, I call it. And I just go to those as a resource. So a lot of the time, this particular presentation.
So basically, you have one presentation.
I have two. This is my annuity search one, and then this one is my income, my preservation of principal, preservation of income.
Right. So today we did this one, the preservation.
Yep. So you saw some of the tools. You saw the presentation here, and then we can do this annuity search one when you want to as well. So.
Hold on one second for me.
Yep.
Hold on.